Hi, everyone. We're going to do the our speaker intro right now so that she can jump into the wonderful content that she is going to provide for us. Uh, Danielle is a financial growth specialist who helps small businesses become financially grounded and increase profits. She works or owns a company called Business Navigators, and they understand the pressures facing small businesses. So without further ado, welcome, Danielle.
Yay. Thank
Applause.
you. Can everybody hear me okay? Awesome. Well, like you said, my name is Danyel Harrison. I am pleased to be here with everyone. I am going to be talking about everyone's favorite subject today, taxes, which first thing everyone should know is, if you're not aware, taxes are due by April 18th of this year. If you do plan to extend filing your taxes, that extension date would mean that your taxes would be due by October 16th. Extending means that you're extending the time that you have to file your return. It doesn't mean you're extending the time that you have to pay taxes if you do owe. So I just want to make sure everybody's got that noted. Some of the things that I wanted to share with you today is, I'm sure everyone's familiar about what tax preparation is, but kind of being in this industry and knowing that sometimes there's some misunderstandings, I just want to make sure everybody kind of is on the same ground. So tax preparation is basically reporting your income and expenses. It's not reducing your tax liability. The tax preparation is just taking the information that you have and just reporting it accurately. And then basically whatever the results are is whatever the results are. Now, when we take a step further from there and start applying credits and deductions and things like that, then that's when we start looking at how can we reduce your tax liability that you may owe, and that is perfectly okay. So it's okay to reduce your tax liability. It's not okay to evade your tax liability. Those are differences there. So when you're trying to do things that are kind of against the law, that's when we're evading. But when we do things within the ramifications of the law and we reduce the liability that we owe, that is perfectly okay with the IRS. A lot of people do it, and you don't have to be super rich in order to take advantage of those tools. So I'm not sure what everyone's experience is as far as like how long you've been a freelancer. Maybe you're just getting started in this. But if you're just getting started, you may be used to, if you've worked a W-2 job where you got paid a wage and your payroll taxes out of your paycheck. Now, as being a freelance artist, that responsibility is on you. So it is important that as you are receiving income for the work that you're performing, you take into account that all of that money that you're receiving is not yours to keep. And so if you kind of get on the practice on the front end of setting aside a portion of the money that you receive for taxes, that makes the preparation and the reporting of your tax liability a lot easier to manage and a lot less stress and anxiety when it comes to April, is when the April deadline is due. Some things to think about during the year. One, we provide accounting and bookkeeping for our clients as well. So that is different from the taxes, but it's also very important. So from an accounting and bookkeeping perspective, it is really good if you have some type of accounting software to use that to keep your finances organized. If you don't, it could be just as simple as keeping a separate bank account for your business activity from your personal account. This makes it easy for when you prepare your tax return. In case of an audit, which tends to be random, it's not something that happens all the time, but in case of audit, you'll be able to go back to an account and you can clearly delineate what you've been using, what you've been receiving, and what you've been spending for your business versus having to go back through and separate what you did personally versus what you did in your business. So that's the first thing that I always encourage business owners to do. You don't have to have an LLC to have a separate business account. That is helpful if you're talking about liability issues. And we'll get into that a little bit separately in Q&A if anybody has questions about that. I can tell you from my perspective, when I got started with my business, I actually just set up a separate personal account that was just for my business activity until I set up my LLC. Then I transferred it over to a business account with the bank. But doing something that separates those two activities would be a world of help for you. The other thing that you want to do is, my personal philosophy is I don't encourage people to just spend a lot of business expenses, create a lot of business expenses just for the sake of trying to reduce your taxes. If you're in the habit of, like I said earlier, setting aside a portion of your income for taxes, grow your business very effectively and make sure that you are spending the money that comes in to grow your business, to make sure you're supporting yourself, and make sure you take care of Uncle Sam. So let's talk about what needs to be reported. So when you're reporting your income, yes, any money that you receive, whether it's in cash, ACH, bartering, whether you are, you use Venmo, any of those things, whenever you do take money in for your business through any of these sources, this is income. And so it does need to be reported. With that being said, we had a deadline that just passed January 31st where 1099 forms were due. And so 1099 forms are the forms that another business will issue to you because you've provided a service to them that typically they may have used someone in-house, an employee, to do that. So since you're not an employee of someone else's business, they have to report that they paid you those funds. And those are, when they send that form to you, that form also goes to the IRS. So whether you receive it, so long as that company has sent it, the IRS will have that on file saying that you've earned $600 or more from this particular business that you did work for. One of the things that I always like to encourage businesses to do is kind of follow the golden rule, which is do unto others as you will have them do unto you. So with that in mind, when you start working for another business, it would be good to have in your paperwork that you provide them with your preferred method of payment, as well as a form called a W-9. The W-9 is an informational form. It says the name of your business, or if it's your name personally, you list your name there. It lists your EIN, which is your employer identification number, or if you use your social security number for your business, you list that information there. That way, when it gets to the end of the year, that company that you're doing work for will know where to issue your 1099. And it's of course, that's on them if they don't issue it, but you've provided all the information you need in order to get paid. On the other side, I do encourage other businesses that when they hire subcontractors or freelance artists, that they require that they get a W-9 before they issue payment. Let's see. Okay, so 1099s were due to be received by, they're due to be sent out by January 31st, which means you would have received them probably in February. Okay, going on from there, we've got the 1099s. Let's see here, expenses that need to be reported. So there's a number of expenses that you can do, especially if you're maybe working from home. So expenses, the thing that you want to think about here is, are they ordinary and necessary to your business, to the business that you're in? So that of course is going to be your direct costs. Your direct costs are going to be expenses related to the revenue that you're generating. So if you think kind of from a production standpoint, if you're making widgets, as they often say, the materials that you had to purchase for the widgets, the labor that went into the widgets, those are going to be direct costs. Now, other expenses that are going to be also tax deductible are going to be your operating expenses. So if you had to pay for advertising, if you had automobile expenses, if you have insurance that you need to carry for your business or for yourself as a part of the work that you're doing. Cell phone, we've already said our advertising. There's a number of other things that we can go through as far as expenses. There are some unique things, like I said, if you work from home, you can take a home office expense deduction. That's typically, you need to have a segregated place that is specifically and that is used for your business. So it can't be like a shared space. And you can take off certain things associated with that area that you're using. So utilities, internet, things like that, all of that can be written off, not the entire bill, but a portion of that can be written off with that home office space. So you want to make sure that you list your income that you've received, list the deductions, and then the difference between that is hopefully you have a profit. It's not a bad thing to have a profit. It's only a bad thing when you didn't plan for the profit, and then now you have a tax liability and you don't have the money for the tax liability. So you see how if we take care of that on the front end, we're not surprised at the end of the year. So what happens is when you have a profit, there is a percentage of that is calculated for self-employment taxes. So going back to my example of when you used to work for someone else, your employer took out FICA and Medicare, your Social Security out of your paycheck, and they took out half of that. That employer was then responsible for the other half. Now that you have your own business, you are responsible for both halves of that. So that percentage is 15.3%. That just takes care of payroll taxes. There's also the federal income tax portion, which that'll get calculated on your tax return as to what that amount is due. But the amount that you want to make sure that you at least take into consideration and have it set aside is at least for that payroll tax, because that self-employment tax is really usually something that you can't really decrease once you have a profit showing for the end of the year. There are some things that you can do, but typically if you've got like $1,000 profit or more, or whatever the case may be, there's not a whole lot to reduce that once you get to time to file your return. Okay, I'll get to that question in a little bit. So let's see, we've got the taxes, the payroll taxes. The reason why your federal income tax is going to be a little bit different is because that's going to, once that gets to your tax return, filing your 1040, that amount is going to be based off of, you have standard deduction or itemized deductions. You also may have other deductions. So like if you do a IRA contribution, there are some other things that can reduce your income. And may even get it to zero. So even if you get your federal income down to zero and owe no federal income tax, you may still owe self-employment tax. So that's why I say at least make sure you've got that 15.3% of your net profit, net income set aside, so that you don't that doesn't end up being a hurdle for you. Let's see here. So another question that may come up is whether to self-prepare or to have a tax professional do this. Typically, self-prepare is either going to be you go get the forms yourself and fill that out, or you go to like maybe an H&R Block or Jackson Hewitt or something like that. I'm a tax professional. I do the taxes, and it's a little bit different than going to like the big block box, but I'm not going to bash anybody. There is a time and a place for that. I would say when your tax preparation gets to be a bit more complicated, and you want to make sure that you've got all the details and everything captured, it might be best to reach out to a tax professional. But a lot of times when you're just getting started, it is more economical to maybe use one of those big box locations. Just realize that when they're preparing your taxes, they're going to take all the information that you provide to them. They may not ask any additional questions. They've got kind of the algorithm set up to go through, and it's like, okay, if you've got this income, they might, it might ask you some follow-up questions about the income, or if you list some certain deductions, they might ask some follow-up questions about those deductions, but it's not going to dig in a lot deeper than that, usually, unless you subscribe to some of the additional services that they have available. But the advantages of maybe working with the tax professional is also potentially will provide tax planning, which tax planning is going to, again, help you to reduce your tax liability, but not just reduce it, but help you to find a way to move those funds that you would have normally paid the IRS to something else. I know we've got someone on here who works with, I think it looks with like retirement investments and things like that. So a lot of times that's a very good pairing, is to have a tax planning strategist with a financial advisor. And that way we can talk about, okay, now that we've reduced this liability, where can we put this money so that we can utilize it and make it make it work for us versus us having to work more for our income. Okay, so one of the questions that came in is, what can you expense if an employer treats you like an employee short-term, meaning you are a W-2 versus a 1099? So there's not a lot that can be expensed. It used to be that, say, if you worked from home as an employee, and you used to be able to write off some expenses, but that has been taken away with the tax and TCJA when Trump came into office. So one of the things that you might check with your employer about doing, though, is they could set up what's called an accountable plan in their business, where that company could reimburse you for your expenses for having a home office, which some places do that. I think I'm still here, I'm not sure. Can everyone still hear me okay?
Yes.
Okay, good. So you could check with your employer to see if they have a reimbursement plan. That would be the best thing I would suggest is if they have a reimbursement plan, then you would just submit your expenses. A lot of times, if you've got, like I said, if you've got a home office, maybe if you're traveling to clients, then they can reimburse you for that mileage. It wouldn't be reported on your tax return, but that would be at a business expense to that employer. They could write that off on their taxes. And that way you wouldn't have to come out of pocket for additional expenses on your side. So hopefully that makes sense. Let's see here. So we covered 1099s, IRA kind of just going through some things that are listed to me. So IRA contributions. IRA contributions, the maximum limit is $6,000 per year currently. That could change when we get for the 2023 year or going forward, but the maximum contribution that you can make this year is $6,000. Unless you're over 50 years old, then the maximum increases to $7,000. There are some other contributions like in your business that you can set up. There's what's called a SEP IRA as a business owner. Those are something that, one, you want to get with the tax planning strategist and possibly your financial advisor to check into the benefits of a SEP IRA versus the regular IRA contributions. We talked about deductions. We talked about setting aside your money to pay into the taxes, but we also want to talk about how you pay that in. So typically you want to make those payments quarterly, your tax funds. If this is your first year in business, you won't have an estimated tax that you need to pay until you file your tax return. So the IRS is not expecting you to pay anything in until you file the tax return, show a liability, and then that year going forward, they're going to, you'll usually have an estimated tax payment that they're looking for you to pay. Once you receive that, then that's the amount that you want to send in. That is the recommendation. Now, if you jump from, say, you made $50,000 profit for 2022, and then your income significantly increases in 2023, you'll want to make more, you want to pay in more quarterly than you did based on what your tax return calculated, because that's such a huge increase that you don't want to have it, again, catch you unaware by the time you get to filing for 2023. That's, again, another area where if you want to talk, make sure you develop that relationship with your tax professional. They can help you review that each quarter before taxes are due. And speaking of additional deadlines, tax payments are typically due each quarter. So quarter one tax return is going, our tax payments are going to be due by April, in this case, April 6th, April 18th. Quarter two is going to be due by July 15th, September, and then January for the fourth quarter. That's typically when your quarterly payments are due. If you have some areas where you can put money aside and it can earn some interest, you can talk, again, make sure you talk with the tax professional about this to see if it's going to be in your best interest. Sometimes it's going to be better for you to set that money aside that you have for your tax, to make your tax payment. Set it aside in an interest-bearing account. If you're going to earn more interest there than the penalty that you might receive for taxes, then sometimes that's something you might want to consider, is just setting that money aside, earn some interest on it, and then at the end of the year, start pay that amount in. If that is not your case, if you've got a pretty high tax bill, then making those quarterly payments is definitely the way to go. Okay, if you don't owe taxes for 2022, still paid into a full-time job, but you will not have a W-2 for 2023 and know you will owe taxes as a freelancer, should you do quarterly estimated tax payments for 2023? I would at least set them aside. This is where you definitely want to talk with a tax tax professional. They can show you, they can help you estimate what those quarterly payments should be, but you won't have an obligation to pay anything in until you file that 2023 tax return. Hopefully that makes sense. Okay. I don't have a lot more to share, so I will just open this up for questions now. If there's anything that I've said that you need some more clarity on, or if you have additional questions, please feel free to.
Can I ask a quick question going back to the IRA contributions?
Sure. Mm-hmm.
So as a part-time employee, I have access to a company 401k, but that job is, 25 hours a month. So the amount I can contribute, even if I put 100% of my paycheck in it, would not be much of anything. Can I choose not to contribute to that 401k and then max out my own personal IRA? Or because I have access to a 401k, is my IRA contributions not tax deductible?
So your IRA contributions are going to be tax deductible. I have to kind of look up that as far as between both of those products. I think more the question that we need to address here is, what's the maximum that you can contribute to both of those without before they're not basically a benefit to you from a tax perspective? Does that make sense?
It does. So
okay, and so hold on just a moment. That's something I'll have to look up as far as what's the maximum amount between those two. But that's the question that you want to make sure you get an answer to is what's the maximum that you can. So actually I have this right in front of me.
So it is okay. So maybe somebody told me that because I have access to a 401k, that I've looked on the IRS website and I haven't been able to, it's not clear to me what the issue
is. You can still
contribute
to both of them. There's just usually a max when it comes to those retirement products. Like with the IRA, you can't contribute more than $6,000, but that doesn't prevent you from
so I could still contribute $6,000 to an IRA, even if like $1,000 is going into a company 401k for the year.
Correct.
Okay. And that 6,000 is still tax deductible for the IRA.
Now, the tax is not dollar for dollar. No, actually brings up another good point that I need to bring up. So we have deductions and we have credits. Deductions reduce your income. So you have a total income number. You want deductions to reduce that income number, because once we reduce it as far as we can, then we get our taxable income number. The taxable income number is where your tax bracket is going to come into play, and that's going to determine what your tax liability will be. Now, once you arrive at your tax liability, then you have credits. Credits reduce your tax liability to dollar for dollar. So if you have children, you have tax credit there. Say it's the $2,000. That's going to, if you owe $2,000, that tax credit, if you have the $2,000 in tax credit, that's going to reduce that down to zero. Now, an IRA deduction, or the contribution to the IRA, is going to reduce your income. So if you contribute the $6,000, that doesn't mean you're going to reduce your tax liability by $6,000. Does that make sense?
Yes, totally.
Okay.
Thank you.
Awesome. What other questions do we have?
Hi there. So I'm a full-time freelancer, and I received 1099s from a bunch of my clients, not all, but a bunch. And then I also received a 1099 from Stripe. I feel like whenever I entered all of my 1099s from the individuals or from the companies, and then I entered my 1099s from Stripe, it looked like I made double. Should I only enter the one 1099 from Stripe, or because each company filed that 1099 and the IRS has that copy, should I still file that so it matches? Because I don't want
The client
to make it look like I'm making double what I did make.
Right. So the clients that sent you a 1099, they paid you through a credit card and that got processed through Stripe. Is that's what happened?
Yes.
Okay. So what you'll want to do is when you report your income, you want to report what's accurate. The Stripe income is going to be what you want to report, and then any additional income. So let me preface this by saying whether a company issues you a 1099 or not, it is still your responsibility to report all the income that you received in your business. Now, what you can do is you can go back to that employer, because if they paid you using a credit card and that got processed through Stripe, Square, whatever, what have you, they should not have issued you a 1099. The merchant processor, that's their responsibility to do that. So you can go back to them and ask them to correct that. The other thing is on your tax return, there are ways that you can report the 1099 and basically zero it out and just say it's been nominated. That's where you'll want to get in, work with a tax professional, because they'll show you how to do to zero out that 1099. Basically, that way you let the IRS know, I'm not trying to evade reporting this income, but this has already been reported somewhere else, so don't double charge me for this. But one, keep the forms that you've received. If the IRS should reach out to you saying that it looks like you have more income, you have the documentation showing that, and plus you have your logs, like you got your bank statements, you show how much money you received for your business. This is also another reason why having a separate business account is really important, because then you show all the money that you received into your business. It matches with that Stripe 1099 or the other ones that didn't come through Stripe. And that way you've got a solid case to support, this is the true income that I received, not what the forms that you have on file. Does that make sense?
Yeah.
She said, yeah. On those same lines, is this the same that goes with PayPal and Venmo and those kind of processing applications?
Yes. So with those type of applications, typically, even though you may have been paid more than $600 from them, a lot of those processors, they wouldn't issue a 1099 unless you had like $20,000 in receipts or like 200 transactions. Now, some of them are getting ready to change that with the new act that's going to be coming into play. They still haven't worked out all the kinks there. But like I said, whether they report it or not, so the companies that you worked for, a lot of them, if they've got an accountant that they're working with, then that accountant should know whether or not they needed to issue a 1099 based on how they paid you. So it's not just the fact that they paid you $600 or more, but it's how they paid you as well. And so if they're aware of that, then they would have issued it correctly. If not, again, just reach back out to them, let them know, hey, you paid me via credit card or you paid me through PayPal or something like that. You did not need to issue a 1099 to me. You want to make sure that if you're using a PayPal or Venmo or Cash App, you're using a business version of not the friends and family. The friends and family version is just for like, we're out to dinner, we're splitting the bill, things like that. It's not meant for business, and it does not protect you for your business. So even though it's a lot easier and we all like to avoid fees and all that stuff associated with processing credit cards, unfortunately, it's just not, it's not to your benefit in the long term. Okay.
Got it. Thank you.
Mhm.
One more.
So still staying on the 1099 question, if someone sends you a 1099 and it's for, let's say, $10,000, but according to your billing, you show it as $10,500. Is that a big deal that there's a difference?
No, but again, when you report your income on your taxes, you should be showing the 10,500. When you get a 1099, it doesn't mean that you have to enter the 1099 on your tax return. You need to make sure you report the income. If the way you report your income is by entering the 1099s that you have, that's fine. But the most correct way is to make sure you report all the income that you've received to your business, which would be the 10,005. And so long as the IRS sees that what you've reported on your tax return seems reasonable compared to the forms that they have on file for what you, then they're not going to, you're not going to have any problems with the IRS.
Most of the time I found that that is because, like, if you billed in December and they didn't pay until January, it's because it will show up on your next year's 1099.
Did that answer your question?
Did.
Yeah.
Yeah, what she's talking about is when, what Tracy was talking about was if you bill them on like December 25th, but they don't pay you until January 5th, then it's
Right.
gonna, it could be off. That's what she's talking about.
Correct.
Yeah, in that same vein, I have a client who cut the check at the end of December, but by the time I got it in through snail mail, it didn't get here through till January. So does that mean I report it for 2023? Even though they've
Yes.
already sent me a 1099 for 2022, that includes it?
So they're 1099, yes, they're 1099. There's a term called constructive receipt. So for you, it's kind of the same thing as when you receive money into Stripe. Even though the Stripe hasn't deposited into your bank account yet, it's still your money to count. And so if so long as they've put it in the mail, then it's on its way to you. And yes, you would count it. It would be part of their 1099 that they've issued out, because for them, they've reached the cutoff date. And just because you didn't receive it until like January 2nd or 3rd, then yes, it would probably still be part of your.
So if you don't do that, are you
Kelly's asking if you don't do that, are you going to jail?
No,
By the date I receive it.
Yeah, I do too.
So I don't go by the date that's issued on the check. I go by the date that
That's what I
I
was
receive it.
I go by because they'll report it on.
I mean, is it kind of
Which they did.
not a huge deal? I mean, we're not talking
No,
millions.
I mean, yeah, we're not talking millions of dollars here. And yes, you could go back to the, let's see here. You can go back to the client and ask them to correct it because you didn't receive it until the next year. And really, I would say probably it hasn't left like if they send you a check, it hasn't left their bank account as of December 31st yet either, most likely. So you could ask them to correct the 1099. But again, so long as, I mean, if you're just talking like, a few $1,000s difference, I wouldn't, don't be worried that the IRS is going to be knocking on your door. It's just a timing issue in that case. Now, there are some ways that, if it's the beginning of the month and you want to postpone, that's usually if you want to postpone maybe giving a bill out, just so you can have that income show up in the next year and maybe not issue the bill until the end of December. So that way, when they pay it, you don't actually get it until later in January, then that definitely gets counted in the next year. But those are just some things to talk about, to think about at the end of the year. If you've got a lot of income reported and you don't need this right now, then yeah, let it go out the first of the next year.
Thank you.
Mhm.
So when you were talking about the IRS, I know there's like unscrupulous things that people do that alert the IRS. Is there any just like things that we should know, just being maybe naive that would alert the IRS? Like, I want to make sure I'm not doing anything that I shouldn't be doing, but yet I don't know that I shouldn't be doing it. Any common pitfalls?
So, common pitfalls.
Writing off your cat.
Make sure you have the separate bank account. Especially if you have like an LLC set up, make sure you have a separate bank account. LLC is not an entity that is recognized by the IRS. That's a state entity, but it does mean that you have a separate business set up. And so that liability can be, that legal protection that the LLC is supposed to give you can be removed if you have commingling of funds. Commingling of funds means you've got business and personal mixed together in the same account. So make sure you keep those separate. Usually where you'll find issues is if you run into, like, if you're taking business mileage, things like that, and you're not reporting it correctly, or maybe like the home office deduction, and you're not reporting things like that correctly. You want to make sure whatever treatment that you're doing, try and be consistent about it. You can't write everything off. So think about, again, going back to, if I'm going to claim this as a business deduction, is this something that's ordinary and necessary to my business? So going to get a manicure, a pedicure, buying a new outfit for, that's a nice thing and it makes the presentation go well, but it's not necessarily a business deduction. So don't think you can claim everything. I was listening to some of the networking before we got started. I know someone here is like a voice actor. So there's some things, yeah. So there may be some things that, voice acting, or say if you're like a hand model or something like that, that might be, that they're going to be necessary for your particular line of work that you're doing. And so that makes sense, but that doesn't mean that it's going to make sense across the board for everybody. I would love to write off my manicures and pedicures, which I need one now, but that just has to come out of what I pay myself. Trying to think of what else. Oh, bartering. So I brought that up earlier. So sometimes, especially as freelancers, you may decide that it makes sense to trade services instead of trading dollars. That's great, but keep in mind that even though you're trading services, that still needs to be reported as income and expenses for both sides. So the way you do that is if they're one-to-one, so whatever service you're providing is going to be to the same value of the service that you're receiving, then it'll net each other off. But if they don't, then whatever the difference is, either, if you got more expense from the service that you're receiving than the service that you give, that needs to be accounted for in your bookkeeping, and that would be a potential taxable income to you or additional deduction to you. So hopefully that makes sense in that capacity. There's not like a lot of red flags that I can think of. A lot of it's just going to be you're trying to claim expenses that just don't make sense for your business. Don't try and write off your vehicle as 100%, especially if that's your only vehicle that you have. That's typically, you can't, your vehicle is not going to be 100% business deduction. Don't fall for the TikTok tax advice, or at least make sure you go and confirm with sometimes TikTok, I have a lot of tax friends that they're on TikTok and they provide great information, but they're only providing part of the information. It's more to get you to ask questions. So don't take it as face value. Make sure you reach out to a tax professional and talk about, hey, I heard this. How does that work? And can it work for me? And let them give you more of the details before you go buy a G-Wagon or whatever the case may be.
Danielle, I've
Question on
got a
the
question.
Sorry, go ahead.
Danielle, my question is, am I to understand correctly in the last few years that they've changed it where you don't necessarily need to itemize your deductions anymore because it won't save you anything more? Something like the
Yes.
tax, go ahead.
Yeah, with the Tax Cuts and Jobs Act that came in play during Trump's time in office, the standard deduction for individuals married filing jointly, pretty much across the board, increased pretty significantly. So typically, in a lot of the itemized deductions, the thresholds, those reduced pretty significantly as well. So for most people that used to itemize, now it doesn't really work to your benefit to itemize. Most everybody's going to be taking the standard deduction on their tax return.
And does the same thing apply to like writing off your mileage as well?
So those are going to be, so when you're writing off your mileage for your business, you have a schedule that's going to be included in your tax return. This is applies to if your business entity you're basically a sole proprietor. You'll have what's called a Schedule C, and on the Schedule C, that'll be part of your deductions that come off of there. So you have your business income, the business deductions that you can take, and then the difference there, if it's a profit, is going to flow through to your 1040 and be part of the income that you report on your 1040. Once you have all the income, so that's business, W-2, that's going to be investments, all of that income compiled together, then that's when your standard deduction or itemized deduction will reduce that amount then any other deductions that come into play. So if you've got a qualified business deduction, the IRA contributions, those are going to reduce that income down to what's called the taxable income number that we talked about earlier. Does that make
So
sense?
Yes, thank you.
So I had a question kind of related to that. I remember a few years back, I don't remember how long ago, but you were able, like when you bought business equipment, you were able to do like a one-time 100% deduction. Is that still in effect?
So that has changed. The 100% deduction ended as of December 31st, 2022, and now it's phased down to like 80%. Now there is still that's the bonus depreciation that reduced. There is still what's called, and the name is escaping me. Hold on just a moment. Section 179, yes. So the section 179 may still be an opportunity for you to 100% write off equipment, but as far as taking bonus depreciation, that's now at 80%, and that will reduce again, I believe, in 2024. So it's going to be kind of phasing out unless unless laws are passed to reinstate that or kind of stop that at a certain percentage.
To that point of buying like, new equipment, if you're just starting to kind of freelance and you've been W-2'd and you need to upgrade your printer or new computer equipment, can you, going back to the LLC question of commingling funds, can you loan your business money to make that initial investment, or do you have to wait until you've earned the money through freelance to be able to purchase?
So you are buying equipment for your business. You just don't have the money from the business to make the purchase yet. Is that correct? Am I understanding your question correctly?
Yes, that is the correct question.
Okay, so this is kind of going into bookkeeping. What you're doing is you are making an owner's contribution to your business. That you can do that. That's not commingling. Commingling is going to be like where you basically use this account that's only supposed to be used for your business, and you go grocery shopping, you buy your movie tickets, all of these things that have to do with you personally. You're using the business funds to take, to support your life. The way that you get around that, or you not get around it, the way that you actually do this is when you want to pay yourself in your business, you just take draws from the business. That's what you would do as an LLC or as a sole proprietor. Now, if you need to put money into the business in order to make purchases, you are perfectly welcome to do that. Again, you want to take the funds from your personal account and deposit them into your business account and then make that purchase that you need to do. The other option is if you do want to actually finance that purchase, you can do that as well. So if you've got a credit card that you use for your business, those expenses can be written off for your business. It doesn't have to actually just be cash from the bank account, but if you use a credit card, you can use those expenses. That should be a separate credit card that's used for the business, not a personal credit card. So those are some different ways that you can, what is it called? Well, anyway, that's just, you can arrive at the same result. Does that make sense?
It does. Thank you.
Sorry.
No, I unmuted.
Oh. So one of the things that I was taught in accounting a few years ago from a business advisor was when you're on your own and you, at the end of the year, you kind of want your balance to be as close to zero as possible. So it's the less taxes that you have to pay. Is that still a realistic goal?
So honestly, I would say that's never been a realistic goal. If you are running your business just so you can pay zero, that's the way to do that. But you have to think about, what are you in business to do? If you're looking to grow and to be as successful as possible, then it's not so much about paying zero, but it's about, again, planning ahead of time. So this is where I would say, like, a lot of times at the end of the year, you might hear a lot of professionals be like, if you've got some equipment that you want to buy, go on and buy that. So if you need to buy equipment that's going to help you grow in your business, that's great. If it's not something that you need, then paying $1,000 to save $10 doesn't really make good financial sense. So hopefully that makes sense. That answers your question. So the reason why you don't want your income to be zero is a lot of times people don't think about the fact that there's other things that you're going to want to do. So depending on where you are in your life, maybe you're wanting to buy a home or you want to buy a car. When you're a freelance and you don't have a W-2 or anything like that, the only income that you have to report is what shows up from the Schedule C. And so if that's always zero, then it's going to be hard to substantiate your income to show that you make a profit and you can support the lifestyle that you want to. So those are some of the things that you have to keep in mind. Maybe reporting income as zero might work for a few years, but after a while, like I said, if there's other things that you want to do, if you want to apply for a business loan, again, vehicle, home, or anything like that, then they're going to want to see that you've been making some income and you can support this financial decision that you want them to make in your behalf.
Interesting.
Anyway.
I don't want to hold all the questions, but I've got, do you guys have anything?
I'll try how to ask this. So this year I'm gonna have both, I'll have business income from my freelance business, but then I also work full-time. So I guess, how much is that gonna be how much does that complicate things in your opinion? Or anything I should, I don't know, look for, do?
So again, with your business income that you've been receiving, have you been reserving anything for taxes from that side? Okay. There's no judgment here. Have you by any chance increased your withholdings on your job?
I don't know. I don't know. I feel like maybe they're higher than where they need to be already. I mean, I think maybe perhaps that is the case, but I'm not
So
for sure.
again, this is your first year. Is this your first year as freelance, or have you been doing this?
It's my second year as freelance, but it's my first year having both incomes, and it's probably my first year of actually making money.
Okay. It doesn't complicate things so much. I don't know where things are, I don't know what your bookwork looks like as far as your business is concerned, but just anticipate the fact that you had more income and you did not pay any additional taxes, really. Like I said, there's two ways that you can do that. You can pay it through your business where you set that aside. You could also increase your withholdings that you have taking out from work to help offset that. It may not take care of everything, like 100% of it, but it will help to, since they take out taxes like every 2 weeks or, when you're working, that'll help to defray that cost. But you do want to kind of anticipate that you may have that self-employment tax is what tends to scare everybody. So just, I don't know if we're talking about and we're not talking about if you brought in $100,000 in revenue, remember, you need to take your business deductions off of there after. So it's not 100,000, it's going to be maybe 50,000 or something like that. But still, 50,000 times 15.3%, that's still a rather large number when you have to come up with it all at one time.
Yeah. Okay. Thank you.
So when you were talking earlier about IRAs, and one of the question was, you can take out up to 6,000 as long as you're under the age of 50. And if you're over the age of 50, you can take out more. But that comes out of your business account, correct? That's not part of an owner's withdrawal or anything like that. This is straight out of your business.
So the IRA is going to be a personal side, but it can help you. So you can pay yourself, when I was talking about the way you pay yourself is you just take owner's draw. So say you take out $6,000, that's going to be an owner's draw, but you take that $6,000 and you use it to fund an IRA because you haven't had you haven't made a contribution at all this year. So that's going to be something that happens on the personal side, but it can help to reduce your liability. Everything that you're doing right now as a freelancer is all going to affect you personally. Until you start talking about maybe if you set your business up as like a corporation, you and the business are the same. So whatever the business does, it's going to affect you personally on your taxes. Did that answer you?
It did, I just didn't like the answer.
I'm sorry. There are some
That was
investments that
epic.
you can make through the business. Again, that's where you want to get in with a financial planner to determine what those options are for you. But there are some, and again, getting a tax plan for yourself. So if you've got a lot of income, there's, again, that's where you might look at the SEP IRA. That's an opportunity to make a higher contribution than the normal traditional IRA.
Okay. And then also, you mentioned that like business taxes aren't due until April 18th. I thought business taxes were due March 15th. What's the March 15th deadline?
So if you are a business entity that is set up as an S corporation or you are a partnership, those are separate business returns that are filed, and those are due by March 15th.
Oh,
So you have, like I said, you might be an LLC. An LLC is a state entity. But from the tax perspective, the IRS would recognize you as a sole proprietor if you're one person, a partnership if it's you or more than one person in that LLC, or you can elect to be taxed as an S corporation or a C corporation.
gotcha. Thank you.
Is there an advantage to filing as an S corp versus an individual?
At certain income levels, yes. So I would advise that any tax professional that just recommends that you set yourself up as an S corporation as soon as you get started in business, run, because that is not in your best advantage, to your best advantage. Unless you already know that you're going to be making like, $200,000 in profit or something like that. I'm just throwing this number out, but if you already know that you're going to have a lot of profit from the get-go, then you might consider it, but typically not when you're just getting started. Usually it's not just the tax advantages, but there's some compliance things that you need to be in consideration of before you decide to elect an S corporation. It can be very beneficial. There's other things besides putting yourself on payroll that you can benefit from, but there's some different things that you have to do. So for example, as a sole proprietor or an LLC, you can do the home office deduction. Well, when you elect to be an S corporation, that deduction, at least the way you take that deduction, goes away. Now you have to set up a plan where you reimburse yourself, and you'd reimburse yourself for the use of your home and utilities and things like that in that plan. And then that's how you get around that. You do have to put yourself on payroll. You need to make sure that payroll is reasonable compensation for you. A lot of times you need to have board member minutes that you set up for yourself. So there's some things that you need to report to keep that S corporation in good standing.
Okay, thank you.
Okay, can you hear me okay?
Yes.
Okay, well, Daniel, I want to thank you. This was super, super informative. And I think I know I learned a lot from your presentation and the Q&A. What else should I say here, Julie?
We're gonna let Tori speak and then we'll just do some announcements as well.
Okay. So I'm going to give this over to Tori. Danielle, if you have other things to do or you want to go get well, you're welcome to do that. Because I know you weren't feeling well today. So I hope you start feeling better soon.
Thank you so much. I did have one other question to come in.
Did you? I'm sorry, I didn't hear you.
Someone asked another question. Would you like me to go and answer this?
Oh, yeah, sure.
Oh, yeah. Sure.
So someone asked, if you do freelance gigs across multiple states, are there any tax implications? So typically there's not, for doing gigs across different states. You just report the income from the state that you reside in. Usually where you have different issues as far as states are concerned is if there's like production or things like that going on in those different states. So if you're traveling to those different states, there may be some issues. But typically if it's just freelance work, like I provide accounting service to clients all across the United States. But I still just report my income for Kansas because this is where I reside and this is where I stay. I don't travel to different places to provide those services.
So services are okay, but the products are not. Right, yeah. Okay.
Okay, all right. I will leave this information. If anyone has any additional questions that you want to, if you just want to send those to info@bnllc.co. And let me see if I can put that up on a whiteboard and I'll share that.
In the chat.
You could just put it in the chat as well if you want to, Danielle.
That works. That's my email address.
So awkward.
Technology.
Okay, I think if there's no more questions, we're ready to have a few announcements and wrap things up. So thanks again, Danielle. This was awesome.
Thank you.